Hi, Mark Kaler. Thanks for joining me. I've never made money in the stock market, so I don't want to put any money there. Investors with this belief are not alone. According to the latest research from Dalbar Inc., many people, including some investment advisors, don't make much money investing in stocks and bonds. Dalbar has figured out why. Dalbar is a leading financial services marketing research firm, and they conduct an annual survey called the Quantitative Analysis of Investor Behavior, or the QAIB. Now, this measures the effects of investor decisions in buying and selling securities over short and long terms. The latest QAIB found that investment results depend more upon the investors' or the advisor's behavior than their knowledge of markets or investment strategies. The results consistently show that those who hold their investments are more successful than those who time the market. Not only do average investors do worse than those who hold their investments for a long time, in many cases, they do much worse. Now, timing markets doesn't mean actively moving in and out of securities or mutual funds on a daily, weekly, monthly, or even annual basis. Dalbar defines a market timer as anyone who holds an allocation to stocks, bonds, or mutual funds for less than 5 years. The average investor and advisor hold their investments for just over 3 years. Now, it isn't that investors and their advisors get the direction of the market wrong most of the time. I thought that was interesting. They were right 67% of the time. Dalbar finds that withstanding the temptation to sell when investments drop in value is far more important to overall returns than a sound investment strategy. The research shows it's easier for people to make the right decision when markets are rising and their fear of loss is not the major driver. When markets fall and fear sets in is usually when investors really hurt themselves by selling out. So how poorly did those who time the market do? Over the past 20 years, and that was from January 1st, 1991 to December 31st, 2010, they averaged 3.83% a year. That's an annual return on their stock portfolios. And these investors put their stock allocation into the S&P 500 index fund and left it alone. Their return would have been 9.14% a year. Now that's a stunning difference of 5.31%. On bonds, they did even worse, earning just over 1% a year. And had they simply put their bond allocation into a bond index fund that tracked the Barclays Aggregate Bond Index, they would have averaged, get this, 6.9%. To compare something shorter and more recent, let's look at the last 5 years. Indeed, investors and advisors did a little better in their stock portfolios, but they didn't beat the S&P 500 even then. They earned 1.61% a year, while those holding the index returned 2.3%. But they still got clobbered in their bond investments, earning an average of under 1% annually, while the index returned almost 6%. This is not good performance. It's terrible. So the takeaway from this and other academic research is pretty clear. Spend your time and emotional energy selecting a good mix of asset classes and mutual fund managers within each class, and then leave them alone. This is doubly important when the markets are doing poorly. The best mutual fund manager in the world isn't going to be able to overcome a decision to sell in a down market. There are times when selling a fund are very appropriate. Consider selling mutual funds if managers change their investment philosophy raise their fees, or begin consistently underperforming other managers in their asset class. Otherwise, it's best to focus on annual rebalancing to keep your portfolio at its original asset allocation. Then you can be one of the investors who say, I keep putting money into the stock market because I make money there. Thanks for listening.